If you have ever stood at an airport kiosk to swap your home currency before a trip, you are already a foreign exchange trader. When people think of high-stakes global finance, they typically picture the frantic trading floors and stock tickers of Wall Street. But look at this chart comparing daily global equity volume to the foreign exchange market. Every single day, over $7.5 trillion changes hands in Forex. It dwarfs the global stock market. Yet, unlike traditional stock exchanges, you won't find a central hub or a physical trading floor anywhere on Earth. The largest financial arena in the world is a decentralized network, operating invisibly all around us. This decentralized structure gives the market a 24-hour operating cycle. It is a constantly running web of institutions passing volume across time zones. Trading essentially follows the sun. The daily cycle kicks off in Sydney. As the Australian workday winds down, the volume rolls over to the trading desks in Tokyo. Then it moves west, waking up the financial district in London. Finally, the baton is passed to New York. By the time American markets close, Sydney is waking up again. This continuous loop keeps the market highly liquid, meaning you can enter or exit trades almost instantly throughout the week. To see how a single person interacts with this sleepless machine, we need to dissect the anatomy of an individual transaction. With a stock, you buy shares of a single company. In Forex, you have to do two things simultaneously. You are buying one currency while selling another. Look at how this typographic layout breaks down a currency pair. We have the euro against the US dollar, or EUR/USD. The first currency listed is always the base, and the second is the quote. Reading the equation below, an exchange rate of 1.10 means it costs exactly $1.10 to purchase a single euro. As a trader, your strict objective is to predict whether the base currency will strengthen or weaken against the quote. There is no static value. You're trading on the shifting balance of power between two separate economies. So what actually makes that balance shift? Prices fluctuate based on the macro-level supply and demand of a nation's money. Central banks act as major catalysts. By setting interest rates, institutions like the Federal Reserve dictate how attractive a currency is. Higher rates draw in foreign capital from investors looking for better yields. Let's say you analyze the economic data and decide to execute a trade. The first hurdle you encounter is the spread, a tiny gap between the buy and sell price, which serves as the invisible transaction cost charged by your broker. To overcome that spread for profit, look at this digital readout. The final highlighted digit is a pip. Standing for price interest point, a change from 1.1050 to 1.1051 is a microscopic shift at the fourth decimal place. That fraction of a cent looks mathematically insignificant, but tracking those tiny movements is the underlying heartbeat of all Forex profitability. To turn those microscopic pip movements into significant money, traders use a tool called leverage. Leverage allows you to control a massive position using only a small amount of your own capital. But imagine you enter a leveraged trade and an unpredictable geopolitical event hits the news. The market violently turns against your position. This is the dark side of leverage. It amplifies your potential gains, but it rapidly accelerates your losses when the market moves the wrong way. Notice how this plummeting line chart instantly stops when it hits the rigid barrier below it? Professional traders use this, a stop-loss order, to automatically close a trade before a loss becomes catastrophic. Traders rely on fundamental economic data and technical chart analysis specifically to calculate where to place these protective boundaries. Longevity in this market is rarely about making the perfect prediction. It relies almost entirely on defensive capital protection. Because it operates around the clock, Forex offers a highly accessible gateway to global finance that can fit around your existing schedule. But the only responsible way to begin is by opening a demo account. Practice executing trades and placing stop losses using virtual funds first before you risk real capital in a $7.5 trillion arena. Your most valuable asset is your education.